Okay, guys, we continue from where we stopped from the last slide presentation or from the last video that I've made. So I stopped at profit commission. So remember, when we talk about profit commission, it is about profit. If there is a profit made by the reinsurer, then going to be commission paid. If there is loss made by the reinsurer, there is no such thing commission paid to the insurer. So profit commissions, there are three types or three systems of profit commission. The first one is called flat rate or fixed percentage profit commission. So the first system here, fixed percentage commission, it doesn't depend on variables such as a loss ratio because the rate has been fixed. Let's say 15% of profit or 10% of profit. So the rate is already there, it's been fixed by the treaty. The second type of profit commission is called sliding scale as a functions of profit, or you call it sliding scale profit commission. And this type of profit commission depends very much on the loss ratio. Remember the scale that I've shown you from the previous video? If the loss ratio is very high, the rate of profit commission will be very low. If the loss ratio is, on the other hand, is very low, that will result in a very high rate of profit commission. And the third one is called 3-year average basis. Okay, I will explain in detail later, but 3-year average basis look at 3 consecutive profit and loss result of the reinsurer. Okay, sliding scale, you please refer back to my previous video, what is sliding scale. Okay, 3-year average basis as a profit commission. So this type of commission depends on the profit and loss account of the reinsurer for 3 consecutive years. So by calculating the average profit over a 3-year, any loss taken into account over these 3 years is important. If the loss is significantly higher, for example, the profit in the following 2 years, profit commission is not available or discontinued for 3 years. Once the deficit year is no longer contained in the 3-year period, there's going to be a profit or profit commission paid to the insurer. Okay, to make it clear, let's look at some of the examples that I have here. Okay, let's say we have year 2014, 2015, up to 2018. If you look at 2014, the profit and loss account of the reinsurer, there is a loss, a deficit of 30,000. So there is a loss for that year, treaty year for the reinsurer. So they're going to look at the 3 average result of 2014, 2015, and 2016. So the second year, the following year, 2015, there is also a deficit of 25,000. So reinsurer is making loss again. And for the third year, there is a profit of 73,000. But anyhow, if you look at the 3 years, 2 years, there are losses and only 1 year with profit. So at the end of 2016, there is no commission paid because commission depends on 3-year average result, which is from 2014 to 2016. So from 2014 to 2016, it is very clear that there are 2 years with losses and only 1 year with profit. So no commission paid end of financial year 2016. So they will have to start from all over again from 2016 to 2018. So I have an example here. For 2016, there is profit. 2017, there is again a profit. And 2018, there is again a profit. So there is no deficit within these 3 years. So at the end of 2018, commission is paid to the insurer. Let's say the rate is 15%. Commission paid at the end of 2018 will be the average of these 3 years. say average of these 3 years times the rate 15%. So commission paid to the insurer gonna be 11825. Okay, so we move back to our PowerPoint. So what is this? So this is, if you can recall from my last video, I mentioned that when there is a profit commission, there is a different system to calculate profit. So this is a profit loss account of the reinsurer. So for accounting year treaty system, the items to calculate profit will be such as this is items under income and these are the items under expenses. And for year of occurrence, there are different items under income and different items under expenses. And if the treaty is based on underwriting year system, there are going to be less item for income and different item for expenses. So again, it depends on whether the treaty is arranged based on accounting year or based on occurrence year or based on underwriting year. Okay, let's say here, I have a profit and loss account of the reinsurer which is based on accounting year basis. So under accounting year basis, the items under income will be 3 items. Premium ceded in the current year, incoming premium reserve from previous accounting year, or you call it portfolio in. So this is the amount which the reinsurer is getting from the previous reinsurer. And this is incoming loss reserve from previous accounting year or portfolio in. And this is also amount carry forward from previous reinsurer. And you will sum up all and you get the total income here. Okay, and then you have to calculate all the items under expenses. So the standard items listed under expenses for accounting year system is commission paid. So this is a commission paid or the flat rate commission paid to the reinsurer. Let's say 30%. So 30% of the premium going to be 180,000. So claims paid during the year 2020. So this is a loss, 240,000. Unearned premium reserve at the end of 2020. So this is considered, this will be registered as an expenses. So for 2021, this will be income. Loss reserve at the end of 2020 also is registered as expenses. So in 2021, this is going to be income. Okay, management expenses incurred by the insurer is 5% of the premium. So this is also expenses incurred by the reinsurer. Losses carried forward, if there is losses, we have to register it here. So in my example here, there is no losses from previous year, so there is 0. And total expenses, if you sum up everything, you will get 810,000. So you minus income minus expenses, you get profit. Okay, so if there is a profit, meaning that there are going to be profit commission paid by the reinsurer to the insurer. Let's say the commission rate is 15% fixed, and profit commission paid to insurer going to be profit here times the rate of commission 50%. That will result in a commission of 7,500 ringgit paid to the insurer. Okay, I hope you are clear. So these are the formula, and remember you have to know what are the items under income, what are the items under outgo, in order for you to do the calculations if there is a question in test or in the exam asking you to calculate profit commission. So this is again some of the examples. Okay, factors which determine commission will be covered in my next video. Okay, thank you very much. And selamat berpuasa.